Nice work setting us up for the earnings this afternoon. I want to bring in Scott Bauer, who's joining us to trade another retail name. Scott is the CEO of Prosper Trading Academy. You got Foot Locker on your mind, Mr. B. Tell me why.
I do, but first off, I have to say, you've probably never set foot into a Ross store. I guarantee that.
Hey,
now,
TJ, I'm a Maxxinista, you know? I'm a Maxxinista. I got loyalty.
There you go. That being said, okay, retail has been, the baby's been thrown out with the bathwater, right? Everybody is down on retail. Everybody wants the babies to have their pacifiers. This is just brutal. Outside of Target, we've seen just retail demolished. However, I really like Foot Locker. Couple reasons. Technically is number one. Technically, this area that it's trading in right here, 53.5 to 54, major support going back a couple years. 200-day moving average, so that's number one. Number two, when you look fundamentally at Foot Locker here, they have really streamlined their supply chain. They sell brands that people still want, right? It's easy to say, yeah, the tariffs are going to hurt because consumers are paying more for the shoes, especially things coming out of China, this, that, and the other. They have really streamlined, and they offer products that people still want. Now, there is going to come a point where enough's going to be enough, and people are not going to pay up for those sorts of products. I don't think we've hit that time yet. And their online business is really accelerating. I love this stock. I really do, Oliver.
All right, so we've seen that, just because you're a retail company doesn't mean, that you're necessarily doomed, right? We've seen some nice performance here.
Right.
Even just, we were just talking about TJ Maxx, but obviously coming up to this, Foot Locker, Nike, the story basically for the biggest, shoe leaders is hugely popular. Everybody's wearing sneakers now just about everywhere, and they've been able to diverge themselves basically from the rest of this market. So, Scott, what's the downside protection though? Because you are limiting the downside risk, right?
Yeah, so here's what I'm looking to do. Obviously, premium volatility is over the top expensive for earnings coming out, right? So I'm selling the 60 call that expires tomorrow, and I'm buying next week's 57.5 call. So basically, I'm buying an upside bullish call spread, but because it's over two different expirations, 1 week apart, it's actually called a diagonal. So I'm looking to take advantage of two things here. Number one, the bullish nature of this $2.50 wide spread, but also the massive amount of premium that I'm able to sell from that 60 call this week. Volatility is absolutely going to get crushed, as we know, and this stock moves higher here, and I win-win. I win on the long deltas, on the long, bias of the spread. I also win on the premium. Now, what can I lose if the stock goes down or doesn't go up that much? I can only lose what I pay, which is 75 cents for this thing. But I see the upside potential here. I see the spread, if the stock does move up to that 60 range, which is about what the expected move is. The option market's pricing in about a $6 move. If we get up to that 60-ish range, this spread probably goes for about $3.50.
Yeah.
So I love the reward to risk on it.
All right, there we go. Interesting stuff tomorrow. We're going to get Foot Locker. So Scott, we will watch it and talk about it. Thank you, Mr. Bauer, as always, joining us from the CBOE to do a little trading. We'll be right back. Let's